Hello, this is Domenico with Easynomics, and we're going to do another perfectly competitive market structure model using crude oil as a primary commodity, and looking at the impact of the Russian-Ukrainian war and the causes of the higher price and how prices fallen over time. In our previous video, we've kind of already illustrated this. We had graph E, the industry or the global market for crude oil, graph F, the individual crude oil extracting firm, and we used the Russian-Ukrainian war as an example of reduced global supply from S1 to S2 as a result of sanctions imposed on Russia, restricting Russian oil imports into the European Union and the United States, and that drove the price of oil up in the crude oil market, which would also raise the price received by firms that produce oil, since these firms are um, producing a homogeneous commodity that's very indistinguishable to a competitor. They do not control price individually. The collective number of firms in the global market collectively may impact the supply and demand, but this is also impacted by a cartel, OPEC, which was also discussed in previous videos, and there'll be links in the video notes below. In any case, we saw how the rise in price for the individual firm generates abnormal or supernormal profit, which is this green area here. And that attracts more investment into the industry, that attracts more firms to enter the industry. And collectively, those firms and those investments would ultimately increase the supply from S2 to S1 to drop price back down. That was what we discussed in this previous video. We're going to do a little different take in this particular video, where we're going to illustrate a rise in demand and an increase in supply. Again, our focus is in this area here. This is a 5-year outlook of crude oil prices. And here we can see how crude oil prices spiked, going from about, let's say here, $90, $89 a barrel, going up to $120 a barrel approximately as a result of the onset of the Russian-Ukrainian war. And then it falls slightly. And so in this video, we're going to try to explain from April to May what's causing this increase in price again. And then ultimately the fall in price, we're going to assume that's a result of increased supply. It's also a result of decreased demand, but we're going to assume that it's an increase in global supply, taking it down to before what it was a year ago. So I will be referencing this article. I created a paper 2 exam. There'll be a link to this article below. And in this article explains the expectation of rising demand before the summer. And so that'll give us a reason to increase demand to explain the rising price. Again, the rise in price here from April to May. And then we'll take a look at how, perhaps as a result of increased global supply, and it's also a result of decreased demand, but we'll focus on, again, that idea of increased global supply causing oil prices to fall and close at prices that were below, they're closing at a 2022 low. This is another great article that I'll have linked below. It just gives a list of reasons why oil prices went up and why they fell. And in that list here, we can see why are oil prices falling. One dominant reason is right here. In July, OPEC leaders finally agreed to increase their production supply by 3.1 million barrels. So that will be a dominant reason, that increase in supply from June to July. We see it's falling. So OPEC had an impact there. And then here it also says that President Biden releasing oil from its strategic reserves, again, increasing the global supply and reducing price. Okay. During that time, year to date, we can see Valaris, which is a offshore drilling contractor, drilling for crude oil. Over the past year, we can see in March how their stock price has increased. Then it fell as we went into the summer, and then it continues to increase into the fall, and it's trading at $60, $70 a share, where at the beginning of the year it's at $40 a share. So if it's at $60, $70 a share, it's about a $20, $30 increase in their share price, which will enable Valaris to increase their investments in building more physical capital, more offshore drilling capacity to increase their supply due to the higher price initially in the year. ExxonMobil, we can also see that Exxon, their share price started at $60 a barrel, and then as a result of the Russo-Ukrainian war, went up to $87, $89, and then it went up to $100, and now it's at about $113. And so that increased investment will enable Exxon to increase their capacity perhaps in the long run. And we can see with Shell Oil as well, their share price rising, falling in the summer, and then rising again, and that will enable Shell to also increase their capacity. Now, these are all forms of negative production leading to negative consumption. So these are negative externalities that we want less of, but because of that higher price in the Russia-Ukrainian war, they're getting more investment. And in this article here, it talks about how Exxon has benefited from the high price in oil. Exxon leads rivals with record profits, record total revenue in its second, third quarter due to the Russia-Ukraine war, increasing global price as a result of sanctions imposed on Russia. And what are they doing with that increased revenue and profit and investment in their stock? Here it explains that Exxon has one of the most ambitious plans in the industry to increase their crude production capacity over the next 5 years. That will lead to an increase in global supply in the potential long run. So let's go ahead and graph a perfectly competitive market and try to understand the year 2022 and that rise in price in oil from April to May, and then its fall from that point on. So first, we're going to look at graph G. It's the industry, the global market for crude oil. We're measuring the price of crude on the y-axis and the quantity on the x-axis. And we'll have an upward sloping supply curve that's relatively inelastic because of its lack of capacity, length of time, the length of time it takes to find and extract oil. So it's a relatively inelastic supply curve. And its demand curve will also be inelastic because for the firms that depend on crude oil as a key input, there's no close substitute. So here's D1 equal to our marginal benefit, and then our S1 curve is equal to our marginal cost curve. And that sets an equilibrium right here, okay? And we'll call that point A. Actually, that's going to get in the way just a bit. So I'll put it right over. So this will be point A, and that will set the equilibrium price at P1 in the global market and equilibrium quantity in the global market where quantity supplied equals quantity demanded at Q1. So when we draw perfect competition, first draw the industry supply, demand, point A, P1, Q1, and then draw a perfectly elastic demand curve for the individual firm. And then we're just going to illustrate this as a kind of a dotted line, becomes this perfectly elastic price that the individual firm must accept. And we'll label this as well as equal to P1, which is also equal to average revenue. But we'll get to that later. So P1 for the firm in this primary commodity market, this perfect competition, price is equal to average revenue, which is equal to the marginal revenue. And I have other videos that explain why. Price is also equal to our demand, which is equal to marginal benefit. So I would label all of this so you're mindful of price being equal to all of these factors: average revenue, marginal revenue, demand, and marginal benefit. Then we're going to have our upward sloping supply curve for the individual firm. It's initially downward sloping, and then the law of diminishing marginal return sets in, and then cost of production increase as we add more variable inputs to fixed resources. I'm going to label this S3. Let me just fix that. S3 equal to our marginal costs of production. And that sets an equilibrium right here. Now, with the perfectly competitive firm, There's an assumption here. We're going to assume that the firm wants to profit maximize. The firm's objective is to maximize their profit. Other objectives could be maximizing revenue, but we're assuming profit maximization. And the rule for profit maximization, and there's other videos I have on my channel that explain this, is to produce where the marginal revenue, produce where the marginal revenue equals the marginal cost. So here we have MR, here is MC, and they intersect at this point. C, I'll call this point D. Okay, so at point D, MR equals MC, so the firm is profit maximizing. And also at this point, we're going to illustrate our average total cost curve. And so we'll have ATC here, ATC here. And that will set output at Q1, Q3. This will be Q4. Okay, so at Q4, it's profit maximizing. And also at Q4, we see that the average revenue, AR, average revenue is equal to average total cost. So at Q4, AR equals ATC, which means that the individual firm is generating normal profit. The price received is covering their implicit and explicit costs. So when you draw perfect competition, this should be the first thing that you draw. This is your foundation. Supply and demand, point A, price, quantity in the industry, and for the individual firm, point D, intersecting with their supply curve intersecting with ATC at its lowest point, and intersecting with the perfectly elastic price. Okay. Just a note here, we're going to state that the PED, it should be known that the PED value for crude oil in this market is less than 1, and the PES value is also less than 1. So both inelastic supply and demand curves, right? Because it's a primary commodity. Higher level students definitely need to know this. Standard level students on the new syllabus, you don't need to know, but in any case, if you're interested in economics, I would say that as a SL student, you should know it. Okay, so inelastic, fine. Some other starting points to remember. In the industry, it's always allocatively efficient, right? The industry is always allocatively efficient in theory. Because it's simply supply and demand and they're intersecting, we see that the marginal benefit is equal to the marginal cost. That MC here is equal to MB. So whatever shifts, it's going to be allocatively efficient. For the individual firm, we can see that marginal benefit is equal to marginal cost. So if it's following this rule of MR equals MC, it's also going to follow that it's allocatively efficient. Sorry. And you'll see that they're always producing where MB equals MC. Okay, I'm definitely running out of room here. But hopefully you can understand that's here. I'm trying to state it's allocatively efficient. All right, MB equals MC, and it's sharing normal profit, and it's also productively efficient. All right, it's productively efficient because at Q4, ATC is at minimum. Cost on average is at minimum. All right, see this point right here, ATC is at its lowest point. Great, so let's illustrate what's happening. So in this paper 2 exam where I used that article, it says here that there's an expectation of rising demand, right? This was printed in May of 2022. There's no refining capacity, so that means that the supply curve is going to be very inelastic. And there's an expectation, that's a non-price determinant of demand. There's an expectation of rising demand in the summer. Soaring demand ahead of the peak U.S. driving season is sending refining profit margins revenue to extraordinary heights, and that was covered in other videos. So let's use that example of the expectation of rising demand, that commodity traders trading in crude oil expect demand to rise as we enter the summer months and exit the pandemic, and that's going to drive demand out from D1 to D2. All right, so here we have the expectation of rising demand, commodity traders buying more crude oil futures, demand shifts out, MB1 to MB2, or demand 1 to demand 2. So demand shifts out. All right, it sets a new equilibrium here at point B. So that raises price in the global market from P1 to P2. Increases the quantity supplied along the supply curve from point A to point B. Quantity supplied increases from Q1 to Q2 along with the quantity of demand. Okay, so here we are. Price has risen. Demand has increased, causing that price to rise. And we see that in the commodity market, right? This is April to May, there's a rise in the price of crude oil. So we're going to assume it's due to that expectation of rising demand, and commodity traders are increasing purchases of futures in crude oil. So that's driving demand up. So that sets a new price that all firms in the industry must accept. So price comes across again to P2. All right, so here we have P2. That's equal to average revenue. And we're going to follow that rule of MR equals MC. Let's label this is P2. It's equal to average revenue. 2 equal to marginal revenue. 2 equal to demand. 2 equal to marginal benefit. 2. So here's MR. And here's MC. And MR equals MC right at this point. So A, B, C, this is point E. Okay, so let's set the quantity at Q5. So there's an increase in the quantity supplied by individual oil extracting firms. Increases Q4 to Q5. And we see an increase in the quantity supplied from point D to point E. All right, quantity supplied is increasing. There's an incentive there to increase output because total revenue and profits will increase as a result. So let's illustrate the costs of production. So we have to use our ATC curve. And here we have cost of production right here. So at this quantity of Q5, costs on average are right here. So I'm going to label this, let's say I'll just call it C2 equal to costs on average ATC 2. So AR is greater than ATC, so the firm is generating supernormal profit. And then we can shade in that area here. So there is the supernormal profit that the individual firm is generating. In addition, I could also highlight how total revenue has increased for the individual firm. Initially, total revenue was P1 times Q1, or P1 times Q4 for the individual firm. And then it increases to this higher price of, let me use a slightly lighter one, higher price of P2 times Q5. So total revenue is increased for the individual firm, and they've also are generating supernormal or abnormal profit, right? So it's increased. So there's an incentive there for the firm to increase their output, to get that supernormal profit, and also to generate more total revenue. All right, so prices are high, total revenue is high, supernormal profit is high. And again, we can see that as a result of those higher prices, it's going to generate more total revenue, more profit, and it's going to attract investment in the stock price of these oil extracting firms like Valeris, like ExxonMobil, from March till May, an increase in their stock price. Shell also from March to the summer months, an increase in their stock price. And that's going to enable these firms to increase their investment in physical capital. And we saw here in this article that with Exxon, they're planning to spend more on increasing their capacity, increased investments on their physical capital to produce more, perhaps in the short and the long run. Also, this article highlights that in July, OPEC nations, a part of this cartel, increased the global supply to ease inflation, to ease rising prices. Everything is tied to oil. All goods and services must be transported on vehicles that utilize oil. So if oil prices go up, transportation costs go up, and that impacts goods and services. And then also we have President Biden releasing oil from the strategic oil reserves. So that's all going to lead to an increase in supply, which is going to drive that price down. OPEC being a contributor to the fall in price, the United States releasing strategic supplies of oil into the world market, and also the higher stock values enabling oil extracting firms to increase their spending on physical capital to increase their capacity to generate more oil, and that could also be a contributor to the fall in the price. So let's go ahead and illustrate that. So now we're going to assume that supply is starting to increase, OPEC releasing the supply, US releasing supply, and also increased stock values for these firms, enabling them to increase their production and investment in physical capital, perhaps their economies of scale, and that will also cause the supply curve to shift out. So here we have S1 going out to S2. Here's S2 equal to our marginal costs of production, and that takes us to an equilibrium right here at point C. And here we have quantity of output increasing Q1 to Q2 to Q3. And thus the price falls in the long run. Further increase in output. And then we have that increase in the supply from S1 to S2. Okay? So prices are going to fall for the individual firm in the long run. Again, we see with perfect competition, what goes up must come down. Those higher prices are not going to be there forever. They're going to eventually fall due to a variety of factors. Part of that being supernormal profit attracts more investment for more firms into the industry. And as those firms enter the industry, they collectively increase the supply, which reduces the price. So price falls, and that's going to cause the individual firms to reduce the quantity of their supply along their supply curve from point E to point D. Right, it's falling back down, or from Q5 back to Q4, in order to maximize their profit or minimize their loss. And they're going to produce again back at Q4 at that lower price with less total revenue and less profit than previously. Again, so here we see again, price is falling. So initially price goes up and it goes right back down more or less to where it was. So this model is very useful in helping us understand that. So now that we've drawn it, I'm going to just analyze it like I would for a paper exam, and then we're done. As can be seen, we're illustrating a perfectly competitive market structure. The primary commodity that's being illustrated is crude oil. Graph G is the industry or the global market for crude oil. We're measuring price on the y-axis, quantity on the x-axis. Graph H is the individual firm or individual crude oil extracting firm. We're measuring price cost revenue on the y-axis and the quantity of output um, on the x-axis. In graph G and H, we have three upward sloping supply curves labeled S1, S2, S3. They're upward sloping according to the law of supply. In graph G, we have two downward sloping demand curves labeled D1 and D2 according to the law of demand. In graph H, our supply curve S3 intersects with the average total cost curve at its lowest point, point D, which represents productive efficiency. Production at minimum ATC is productive efficiency. In addition, we can see that the firm is facing two perfectly elastic demand curves, labeled P1, P2, but we'll explain that in just a moment. So in graph G, we have an initial equilibrium of where D1 equals S1 at point A, establishing an equilibrium price at Q1 and equilibrium quantity supplied and demanded at Q1. That becomes the perfectly elastic price that the individual firm must accept, where price P1 is equal to average revenue 1, equal to marginal revenue 1, equal to D1, equal to marginal benefit 1. We're going to assume that the firm wants to profit maximize, so they'll produce where MR equals MC at point D that sets output at Q4. We notice that at Q4, average revenue equals average total costs, so the firm is generating normal profit. And we also see that at Q4, they're producing at minimum ATC, so the firm is productively efficient. And we also see that at point D, marginal benefit equals marginal cost, so the firm is allocatively efficient, as is the industry. Then, as a result of the expectation of rising demand as developing nations exit the COVID pandemic and enter the summer months in the Northern Hemisphere, there's an expectation there'll be rising demand for travel by road, by air, and that will cause commodity traders to increase their demand for crude oil futures. So demand increases from D1 to D2. That sets a new equilibrium at where D2 equals S1 at point B, which is allocatively efficient, but it raises price from P1 to P2 and leads to an increase in the quantity supplied and demanded from Q1 to Q2. That becomes the higher price that the individual firm must accept, where P2 is equal to AR2, equal to MR2, equal to D2, equal to MB2. Assuming the objective profit maximization at point E, MR equals MC, that will set output at Q5, so firms will increase the quantity supplied from point D to point E, or from Q4 to Q5. At Q5, we see that P2 is greater than C2, or AR2 is greater than ATC2. Thus, the firm is generating supernormal profit, which can be illustrated by the green shaded area. In addition, we can also state that total revenue has increased. We can say that total revenue initially was TR1 is equal to the price of P1 times the quantity of Q4. And then it increases to TR2, the higher price of P2 multiplied by a higher output at Q5. Thus, total revenue 2 is greater than total revenue 1. So the individual firm is generating supernormal profit and greater total revenue. But at Q5, we notice that their costs on average have increased, that the ATC at Q5, ATC at that point is greater than minimum ATC. So the individual firm is productively inefficient. but the individual firm is still allocatively efficient. At point E, marginal benefit equals marginal cost. The higher profits, the higher revenue will attract more investment into the crude oil industry, which is unfortunate. It's going to slow down our ability to address the climate crisis. These are investments in a negative production externality, which will lead to a negative consumption externality. But more investments are being poured into firms that extract crude oil, as we saw in those stock prices for Valeris, ExxonMobil, and so on. In addition, OPEC has increased their output of oil into the world market starting in July, and the United States has also released their strategic oil reserves into the world market. All of these are causing the supply curve to shift out from S1 to S2, setting an equilibrium at point C where S2 equals D2, uh, reducing price from P2 to P1, but further increasing output from Q2 to Q3. That becomes a perfectly elastic price that the individual firms must accept. And at that lower price, firms must reduce their quantity supplied along their supply curve from point E to point D. And so they're going to produce where MR equals MC at Q4. And at Q4, we see that the firm is generating normal profit, average revenue equals average total cost, and they're also being productively efficient because they're producing at minimum ATC. Okay, so that's an analysis with some hints and evaluation in terms of allocative and productive efficiency. And that's it. If you have any questions, feel free to comment those questions below, and don't forget to subscribe and to like. Thank you so much.